For starters, we had that big two-day rally after the tax cut announcement. Do you think that is fading away now, or do you think it's natural to see this kind of move after that big rally?
Well, yes, I guess to some extent you need a bit of consolidation, but there have also been other factors that are driving the markets which will soon take over. Remember, the tax cuts, the real effects of the tax cuts will show up in fundamentals in some time. I guess you'll have to see either price cuts from the companies which are benefiting them, or they implement wage hikes which can boost consumption from those employees, or they start new capex projects. That perhaps is the longest cycle. Until
wage
then,
hikes, really? We'd wish, but
I know that.
On a lighter note.
I'm just laying all the options on the table. But most likely, I think the most beneficial one is if they can plow back into investments and grow their asset book. But like I said, it's going to take a while before it starts showing up in fundamentals, and hence there'll be other factors which will take over what drives the market. And we've seen there's been a global news flow hasn't been particularly supportive, either in terms of growth data points or on the political front. There's much action there, so it's bound to be should have consolidated. I think we're going through that phase now.
Okay, so till clarity emerges on really where the tax cuts show up, and also to what extent, I mean, now there's the issue of MAT, so whether you'll move to the lower rate or not, etc. Till that clarity emerges, what next for the market? Is it going to undo more of that gain? Because the surge on that Friday and the Monday that followed was 1,000 points. Right. And now we have given up almost, what, I think 400 points from that peak. So will there be a further slow grind down then in the interim?
Quite possible. I think it all depends on how the some of the lenders, particularly one bank and one NBFC, which has been in the news and perhaps which has been the primary driver of this fall, how do they pan out over the next few days? And more importantly, what are going to be the second round effects? Because there are going to be ramifications. There are other lenders who have exposure to these two entities. Sooner or later, those names will come up. So unless and until we see a quick fix to this, I don't know what the quick fix is. There could be contagion effect, and which would mean that the financial sector could be leading the markets down over the next few weeks, unless and until we see a quick solution.
Let's plot the intraday chart on Titan, by the way. That stock is down about 4% right now and is trading at the low point of the day. So it's a sharp fall, which is now visible on that stock. So there is a bit of a fall. I think our sister channel was flashing some information about a sharp drop in gold imports, but that stock is down about 4% right now. So Pramod, there is a set of stocks, Titan is part of that, where of course so far there's been no problem in growth, but you could argue about the valuations. So do you keep these stocks in your portfolio, or do you look for newer opportunities?
No, we do own Titan in some of our portfolios, and I think it's a structural play. I don't think the current valuations really factor in the longevity with which companies like Titan can grow. And Titan is a classic example because it operates in a sector which still remains largely unorganized. Then the organized sector is not more than 20% of the market, of which Titan is half. So the growth runway is long. If Titan can compound at 15-20% for the next 20 years, I don't think the current multiples are adequately factoring it.
But can it? That's
given the runway, right? So even if they double from here, there'll still be 20% of the overall market. And there is no large pan-India jewelry retailer on the horizon to that extent. And given the changes that the economy is seen through, it's becoming increasingly harder for the mom-and-pop jeweler in your friendly neighborhood to operate, and as a result the sector naturally lends itself for consolidation. And amongst the leading pan-India jewelers, we can't see anybody other than Titan being the biggest beneficiary of it. So it's more the longevity of growth which gives you the confidence that we don't think it's adequately factored in the price yet. There will be periods like this when gold price moves swiftly and people sort of delay their purchase decisions. But sooner or later, the gold price will settle down. I think the original demand will come back.
You do have a lot of consumers actually in your portfolio because they meet your, certain criteria on ROAS, etc. I'm not quite sure whether Jubilant FoodWorks still makes the cut for you.
No, unfortunately not. While historically we had a great high return on capital, I think the incremental return on capital has been dwindling for quite a few years now. And you talked about Zomato and Swiggy just a while back, and those have been exactly the sort of reasons how Jubilant's moat has been dented, and we don't reckon they have something different to offer the market, because there are plenty of other options for the consumer, and more importantly, there's plenty of money chasing those options. So you have competition, well equipped with the capital to sort of destroy the industry economics, at least for the time being.
Okay, what about some of these pharma names making a bit of a comeback, over the last few days? Pharma, healthcare included, like Apollo Hospitals, that's also done well of late. Any picks here, Pramod?
No, we have been looking at it very closely. We have a couple of names in our portfolios, but I think that the clear driver is, especially for the export-oriented pharmas, we've seen some sort of a depreciation in the rupee. There's perhaps more to come if we see the sort of policy changes that we've gone through. A fiscal expansion would necessarily mean some further depreciation coming through on that side. So that's clearly a tailwind. But having said that, I think the erstwhile challenges around regulatory, lack of a product pipeline, the bargaining power which has been ceded to the distribution in the Western world will all mean that we may not see the best of pharma ever again. Something like the 25-30% growth that we used to see may not be back. So to the extent that prepared for a 15-20% growth, we reckon a little more correction on the valuation front would be interesting.
Do you have any financials right now in the portfolio? And if so, what kind of stocks would you be comfortable holding? Because I think it's just going back to the oldest names in the books all over again, right?
It is. I think more such incidents like the ones earlier this week mean that you got to be even more safe when you play financials. We've got HDFC Bank, Kotak Bank, Bajaj Finance, and the likes. So we're quite comfortable with their exposure in terms of asset quality, but at the same time, we derive comfort from the fact that they're very strong CASA franchises, particularly the two banks, which give them the comfort to cherry pick the sort of assets they chase with the lowest cost of funding that they have. It's a huge competitive advantage. So we're quite comfortable with those names from a long-term holding.
So, what's your market call now, Pramod? You were bearish before that tax cut announcement, and that call worked out. That tax rate, has that changed equation, or we're still trying to figure out, of course, but that changed sentiment for sure, at least. So, has that changed your overall bearish call, or are you still bearish on the market? No,
I think the market as a whole will continue to remain less attractive. The tax cuts, unfortunately, have benefited the same names that were doing well, right? By definition, the tax cuts benefit the most profitable companies. True. Add to it one more layer, it benefits the companies which have the highest return on capital and the highest reinvestment rates. So it's going to be the same old set of companies which will benefit even from this decision. Okay, what if there's a personal income tax cut? And because see, the way I look at things right now is that this is a government which has now realized that something needs to be done, and it's willing to do that. Do you think if that was to follow the corporate tax cut, that would be a bigger trigger, you think? I call it the last Brahmastra. So, your thoughts? No, I don't think there is any such thing as, it'll have to be a miracle to turn things around overnight. So the corporate tax cuts will also have the secondary effects on the broader economy. Look, as and when these companies, while it benefits their earnings and earnings growth, the spend that they will do in terms of deploying more capacity and stuff, which will have a trickle-down effect on the rest of the economy. So I don't think we should see that as restricting to these handful of companies. This handful of companies will grow their earnings better, but there will be broader economic benefits. The same thing with the personal tax cuts as well. But I don't think you should expect, sort of a quick fix or a rapid V-shaped recovery. It'll be a slow recovery, but all these steps do matter. They do count in the long run, but one needs to be patient. Look at this. We've been speaking for about 10 minutes. We've not even spoken about the 25 basis points rate cut, And that's the I think the sentiment in the market as well, right? They've done 135 basis points this calendar year. The market just doesn't care. Yeah.
So what's the missing link over here?
I think it's transmission. I think we've spoken here in your very studios in the past as well. I don't think there is an issue with the system level liquidity. Borrowing today for those who need money is happening at 14, 16, 18, 20%. Some of the really weak balance sheet ones are prepared to pay 30%. So 25 basis points in the grand scheme of things not going to move the needle. I think we still need to go back and fix that logjam, break that crisis of confidence, give some clarity to the market that these are the balance sheets which are transparent, which are worth lending. At least some aspects of the last mile NBFC community starts getting access to that liquidity. They start on lending and things start moving at the ground level. Until then, no amount of rate cuts and liquidity pumping will make a big difference. But I guess, from what we understand, there are certain aspects that the government is working on and the RBI is working on, which should see more clarity on this aspect. But from the time that we last spoke, I guess things have only got even more trickier. If you're a lender, you'll be even more, you'll be tightening your purse strings rather than looking to, grow your loan book.
Final question then, how do you look at the government's move of privatizing BPCL? Because there's obviously it sort of, it sends a good message across and it sort of revives the sentiment. But at the same time, you're asking yourself, this is almost like selling, family silver, and there are not too many such assets like BPCL. So it solves the near-term problem, but then in the medium term, you're not left with too many, right?
True, and I totally agree with you. It's good from the fact that in a year like this, when you've got these corporate tax rate cuts, the government's finances need to be boosted. So even if it means you're selling family silver, eventually I guess you should be getting out of most businesses. Like somebody said, the government has no business to be in business. To that extent, I think it's the right move. Whether it means investors should be looking at PSU assets as an investment opportunity, I still don't agree with that. It will have positive effects through the government finances being slightly better, and hopefully we'll avoid a proper crowding out given these tax rate cuts, the government borrowing going up, and hence the transmission again being affected in the financial system. So from the broader economy perspective, it is a positive move, and hopefully when the markets recover, they should be able to get off the less than attractive assets as well. But that's clearly on the agenda, and it should be welcomed.